Hey, good evening, everybody. Good evening, Victoria. Good to see you. We will get started in about 1 minute or so, give or take. So we'll just give another minute or so for some last minute folks to connect and we'll get started. All right, good evening, you guys. We are going to get started just so we can stay on time. Obviously, we have a lot that we're going to talk about tonight. And by the way, so if I don't know if everybody was here last week or not, if I think I've met pretty much everybody here. Again, my name is Robert. I'm excited to have a chance to go through workshop number 2 with you. As we talk about this, this subject that's, affecting, millions of people to the extent of, I guess I'll start the meeting with, putting this on your mind. And I know I shared it a week or so ago with some of you. If you go on the website, gofundme.com, and if you just type in one keyword in the search, if you type in the word funeral, you'll find approximately 2.8 million people unfortunately asking for money for donations because someone passed away. And I think because those people didn't have proper protection for their family. And so tonight is going to be all about proper protection and taking somewhat of a complicated subject that people have had for it seems like far too long in this country. And hopefully we can simplify it for you a little bit. So if you give me a second, I'm going to share my screen and we're going to get started. And by the way, if you have your workbook, hopefully you do, but we're going to be on page number 25 is where we're going to begin. And I'm going to get this thing out of my way so I can see this thing. And so hopefully you guys can see me. If not, unmute and shout out because I cannot see anybody other than the PowerPoint. So again, we're going to go to page 25 of the workbook. And I'm going to get us started here as we click through the sign-in and everything. Again, the context of this is normally in our financial centers, and hopefully everybody's doing well with the whole lockdown situation. But we hope we did your homework. But let's go to page 25 just so we can really get started and really figure out what we're going to discuss today. And the first part we're going to discuss is how to have a strong protection plan. Something that we feel most families have really overlooked, how to have a strong plan in place for their family. We're also going to discuss the relationship between building wealth and fulfilling your responsibilities because these things kind of work together. And so we want to, we want to really properly fulfill those responsibilities while building wealth at the same time. And so it's important for people to understand. We're going to talk about, do I need life insurance? Some people think everybody needs life insurance, and that's not necessarily true anymore. And so what we want to figure out is, does everybody need life insurance? Okay. If so, how much life insurance? Unfortunately, there's a lot of people who sell insurance who don't necessarily educate people on insurance. And so we want you to be able to figure out how much should you have if you need life insurance. We're also going to discuss something that's really exciting is the different types of life insurance. There are many types. There's an iPhone, there's an Android, there's other versions. And so people have preferences. And so we don't want to make assumptions today that every type is for everybody. There are different types for different people, different scenarios. We're also going to finally focus on how to choose the most suitable plan for your family. We feel that at the end of the day, you've got to be able to make the right choice. And I think the education is what that's all about, to make that decision. And so again, some of the challenges here as we continue on page 25. Number one is to protect our family for these areas primarily to think about: your life, your health, and your disability. We say, what if you die too soon? What if you get sick? What if something goes wrong? So you have to be in a position to protect your family. Those are challenges that all of us face. Literally, none of us are untouchable by these challenges. We have to protect our family. And we also have to focus on reducing our liabilities to get out of debt sooner. I know last week, that was essentially the focus of our conversation, was getting out of debt. If you look at the Debt Clock website, by the way, I looked this week, it's up to almost $25 trillion. Literally, the last time I looked, it was 23 trillion. And so the debt is out of control. We got to help people with this thing. Also, dealing with constant changes in your job, career, or business. We're seeing industries being disrupted. Some of it's not very good because people are losing a lot. And so this is a big challenge that all of us are facing. And so we've got to figure that out. And also living a long life without adequate income, probably one of the more scarier things for someone like myself. I'm worried about that, Well, there's not a lot of pensions. Social Security is not a lot of money. So if you don't save a lot and have assets and things, you could really live a long time without a lot of money. And that's not a good place to be. And so we want to really focus on figuring that out and having a plan. And so page 25, there's what's called the financial foundation. It looks like a little bit of a wedding cake here. And there's an order. And so I want you to fill that in the book if you can. This is something that's really important for people to pay note to. The foundation is proper protection. We then focus on debt management. We're going to talk about these dynamics. We then focus on having a solid emergency fund, typically 3 to 6 months. We talked about that last week. And then finally talking about investments and savings and long-term planning and things like that. And it says, like building a house, you must build it from the ground up. Many people, they say, no, Rob, I want to invest. I want to buy this real estate. I want to do this. And I say, no, I understand, but think about it. Does it make sense to many times go invest your money if you have credit card debt at 30% interest? It may make sense to pay the debt first. Again, there's always exceptions to all these rules. And so there's an order that we feel like people should really follow. And it says, without a strong foundation, everything you have may not last. And again, being in the financial industry and educating people for 20 years now, I mean, it's crazy because I can't get a haircut. My hair's growing and I have all this gray hair. It's like, man, it's been a long time. I've seen people lose things. And so the reality is we've got to have a strong foundation in place. And so we're going to go on, okay? And we're going to talk about a concept on page 26 called the X curve that essentially has 2 curves. And I'm going to kind of talk about it, and then we'll bring up the slide so you can fill it all in. The first curve is called the responsibility curve. Some people call it the law of decreasing responsibility. And here's essentially what it means. The left side of the screen, you're young. The right side of the screen is you're older. It's like a timeline, let's say. On the left side of the screen, when we're young, we normally have financial responsibilities for children. We normally have financial responsibilities for a mortgage, saving for those kids, potentially go to college, paying down debts, things like that. So when we're young, it is usually assumed that there's a high level of responsibility. As we get older, we should have an intention of lowering those responsibilities, paying down those debts, educating those kids, and finally getting that financial burden out of your back pocket. And so it's a law of decreasing responsibility. Again, as we get older, we've got to have a plan. Again, hope is not a good plan, by the way. I want to remind you of that. It's not a good strategy, I should say. I think you should be hopeful, but you should have a specific plan. What is the plan to reduce your debt, reduce your responsibility, things like that? When we're young, we typically have less savings and high responsibilities. And again, when we're older, the concept is we have less responsibilities when we're older, potentially looking at retirement and things like that. The wealth curve, which goes the other direction, typically starting low, and then hopefully, again, strategically, it needs to go high. You've got to have a plan to build wealth as you get older. Some people call it the law of building wealth, the law of increasing assets, things like that. Again, when we're young, we need to learn how to start to save and invest. I don't care if it's $10. If you got a stimulus, hey, that's extra money. People say, no, I need the money. I understand. But what if it was only $1,000? You'd probably make it work with only $1,000. So maybe you could save $200. I don't know. Everybody's situation is different, but you've got to make a decision to start. Someday you've got to make a decision to start. As we get older, we look at this, we must accumulate wealth. Because the reality, like we said a few minutes ago, there's no more pensions. Social Security's in trouble. You've got to have money or real estate or assets, something that you can live off of. More wealth, less responsibility when we're older. And so it says at the bottom of the screen, get enough life insurance protection when you are younger, reducing your protection need when you build enough wealth. The concept of what's called self-insured. Imagine, we look at this X curve, we'll bring it up so you can fill in the book properly. Imagine most people in this country, if you look at it, the left side of the screen, it says less secure. The right side of the screen is generally more secure because they have more money. They have less responsibility. And so you think about the average family today during a crisis, as we record this thing, it's 2020, it's a crisis. We might be able to look back at this and say, wow, look at what happened. But most families are living in this world of, man, my financial situation is not good and I have a lot of bills to pay. So the name of the game is what we really believe in, and educating people is, again, building that wealth while reducing that responsibility, because the right side of the curve is about freedom. It's about security. It's about, hey, if I don't have all those bills, I don't need to go punch a clock and do something I may not enjoy doing like many people do nowadays. And so it's really focusing on taking care of your future. And so it's a powerful concept, okay? Let's go to the bottom of page 26. We'll do some true false. We'll just throw some random stuff around here. It says, if you are a joint account holder on a credit card, you are liable for the debt if your cosigner passes away. The correct answer is true. You are responsible. So my advice, don't cosign. I do mean it, especially for family members. It creates a lot of dynamics. Some people disagree with that, but I don't think you should be a cosigner in most situations, okay? It says, according to the responsibility curve, you will have more responsibilities when you're older. That is actually false. We would say the responsibilities, we want them to go lower as we get older. It says if your children are minors, they will not receive life insurance proceeds until they're 18 years old. That is a true statement. So it's very important that you don't list minor children as beneficiaries. You really want to make sure you have that set up properly. Also, when you make a minimum payment on your mortgage, you will pay more in interest. The answer is true. Again, I would remind you the word mortgage in Latin means death pledge. You should look into that. So we should try to pay that down, okay? And it says you should also have a high amount of insurance protection when you are older. That's a false statement, because it's saying, well, if you have all that money and you don't have those responsibilities, you don't have a giant need for life insurance. What's called self-insured. So on page 27, I'm going to pull this up and I'm just going to read it to you. It's a powerful little letter here. It says, hello, I am your life insurance policy. You and I have similar purposes in this world. It is your job to provide food, clothing, shelter, schooling, medicine, and other things for your loved ones. You do this while I lie in your safe deposit box. I have faith and trust in you, and out of your earnings will come the cost of my upkeep. And at times, I may appear insignificant to you. But someday, and who knows when, we don't know when, you and I will change places. When you are laid to rest, I will come alive and do your job. I may provide food, clothing, shelter, schooling, medicine, and other things your family will continue to need, just as you are doing now. When your work and labor are done, mine will begin. Through me, your hands can carry on. And whenever you feel the price you're paying for my upkeep is burdensome, remember that I can do more for you and your family than you will ever do for me. If you do your part, I will do mine. Sincerely yours, your life insurance policy. And so I like to read that in the reality of nobody's thinking about passing away. Not a lot of people are excited about life insurance. And I'm not here to get you excited about life insurance. I'm just here to get you to have some peace of mind in your heart to say, you know what, if something were to go wrong, what is my situation for my wife, my husband, my kids, whatever the situation is? Because most people have not given it the proper level of thought, in our opinion. So we're going to go to page 28 and discuss what's called the DIME method, D-I-M-E. Very, very simple method to calculate how much life insurance do you actually need. Because an insurance person typically will say, no, you know what, Bob, you need X. And that may be accurate, but this is probably the most specific way to do it. It's very simple. It stands for debt. It stands for income replacement. It says times 10 on the screen, but we'll talk about that. It talks about mortgage, and it talks about education. Debt, income replacement, mortgage, and education. And it's very simple. If I were sitting down with you and your wife and I looked at Stephanie's husband, Adrian, and I said, you know what, Adrian, if something were to happen to Stephanie, God forbid, would you instantly want the ability to pay off all the debt, not including the mortgage, yes or no? And we would fill in that amount on the debt. I would say, if God forbid something happened, for how many years do we want to replace that lost income? Because otherwise the lifestyle is all screwed up. Most families cannot survive on a single stream of income if they've built a lifestyle around two. So the most important part of this formula is income replacement, you guys. It really is. So we would ask, for how many years? We would then go to mortgage and say, hey, if something were to happen, would you also want the ability to pay off that house and write a check? Yes or no? And the final one of education. If something were to happen, would you instantly want those college education accounts funded? Because doing it on a single income could be radically harder. And so if you would go through this, you'll find most people say, man, I'm really underinsured for what I want or what I need. And so it's very important for people to look at this and calculate it. It says the only reason you buy insurance is to have enough coverage for the potential loss. So think about it. No one would buy $100,000 coverage for a $500,000 home. $10,000 for a $50,000 car. They don't let you do those things. But we see people with kids and stay-at-home spouses and all these things. And I say, hey, tell me about your life insurance. And they go, oh, I haven't gotten around to that. Or I bought it through my job. And I say, tell me how it works. Most people don't know. And so it's really important, you guys. At the bottom of page 28, there's a little chart there. We challenge you, fill that in. Look at your car. What's the value? What are you covering it for? Do you know your car insurance? Most people don't. And you can run those numbers for yourself, or again, we can help you figure that out. Likewise, if you have 100,000, if you need $500,000, we think it's important to have the proper amount. Okay, all right, we're gonna go on. So how do you buy life insurance? It's interesting. You buy it like everything else in the world. It's very simple to understand. And this is the part that I find most people who buy insurance never give it thought to. And I'll introduce it like this. Have you ever been to a gas station where you're sitting there pumping gas and right across the street, the same gas, maybe a different brand, it's like a way different price, like 20, 30 cents more a gallon. You may ask yourself, why are people doing that? Well, they sell theirs per gallon at a different rate. And what people don't realize is all life insurance is sold the same way. So on the screen, it says, for example, sugar is sold by the pound. Eggs are sold by the dozen. So everything has a unit of measure. Life insurance is sold by the $1,000 unit of insurance, what's called COI, cost of insurance. It is priced per $1,000. Like a gallon of gas, $1,000 of insurance is an equivalent unit. It's one unit. So some people buy insurance and I say, hey, the company you bought it from, do you know where they rank in their cost per gallon? And most people look at me like a space alien. They go, what are you talking about, man? I don't know what that means. And when we look at it, they are often overpaying for life insurance. And so it's really a very simple concept to understand. So we're going to do an exercise as we go along here, but I want to make a couple of points here. It says the cost goes up every year. So this is something you need to know about all life insurance. There's a lot of types, and we're going to talk about them in a moment, you guys, but all of them, including the ones that appear that the cost does not go up. People say, no, Rob, my cost stays the same my whole life. It's not true. You don't understand how it works. It's not true. The cost goes up as you get older. All life insurance, all companies in North America work this way, by the way. Why is this? Well, it's based on statistics. They say the older you are, the more likely it is something may happen, and we're going to pay this claim. And so if we look in the workbook, we're going to do an exercise. It's not on the screen. We're going to go to page 29 of our workbook. And I just want to help you kind of do a little calculation here so you can see how this works. And at the top of the page, it says Mary is 40 years old and she smokes cigarettes. Based on her dime method, she wants to buy $500,000 of life insurance. Please calculate her annual premiums looking at the table below. So if she's 40, if she has, it says $2 per thousand. If she wants 500 units, because it would be 500,000, so 500 units, 500 times 2 would be how much? It would be $1,000 a year. That would be the answer. $1,000 a year would be her cost. You'll notice the next year, the cost slightly goes up by 15 cents per thousand. So you can just run this calculation and start to realize, wow, all life insurance slowly starts to creep up, even if it doesn't seem that way in your premium. Again, we're going to go through how that works. Okay, so it's very, very simple to understand. And by the way, I know many of you, this may be like, what the heck? I've never talked about this stuff in my life. Please don't let this be intimidating. I know this might be the very first time some of you are hearing it. So if you feel that way, I used to be an airplane mechanic, and I know how you feel. So just so you know, we relate to you. So please, hang with us. So how are insurance premiums determined? A couple of things. Number one, you must qualify. It does determine your health. Your health has so much to do with this. Some people think, no, I thought that all changed with something in the government. That's not true. You've got to be in good health. Here's what they base it on. Here's how they're going to discriminate against us. Okay, we don't like it, but it is what it is. Our height and weight, they have ratios, and they go, hey, if you're out of that, you're going to pay more. If you have health issues, present issues, or maybe in the past, they're going to use that against you. Medications you're on, because that's an indication, hey, what's going on here? Tobacco usage, we're going to talk about it. They really use it against you. Your family history, your driving record, your criminal record, and high-risk activities. And so if you're a skydiver or some crazy extreme, thing, they're going to use that against you when it comes to buying life insurance. Okay, so let's look at page 29 real quick, just to make sure we're not missing anything in the book. In the middle of the page, it says circle the items that are not factored into the rate of insurance premiums if you have a workbook. And here's the answer. Your hair color does not matter. Your religion does not matter. And your eye color does not matter. And riding a bike does not matter. That is not high risk, riding a bike. So anyway, we will go on. After you look at those factors, they're going to put you into a category called a rate class. Okay, very simple. There are three primary areas of rate classes, very easy to understand. There's what's called standard, which means, just like it sounds, standard, normal. You're in the middle. Then there's what's called substandard, which we're going to pull all this up on the screen. Hey, there's some issues here. And then there's what's called preferred, which means, wow, you're better than the average person. So the rate classes in most insurance policies look like this. Preferred elite, again, that's what's called preferred. That's the best one. You have optimal health. Then there's a next one down called preferred. You're pretty good. You have a really healthy situation. You're not the best, but you're pretty good. Standard, like I said, you're right in the middle. Maybe some issues, maybe a little bit of weight. Maybe you got some stuff going on, normal things. If you're a healthy smoker, AKA preferred smoker, you'll notice it says 2 times the above rate. I'll tell you, for tobacco users, it's difficult. Life insurance gets very expensive for tobacco users because of statistics. And so if you're preferred, it's 2 times. If you're just a regular smoker, it's 3 times the amount. It's crazy, the cost. Then there's what's called table rated. Table rating means, you know what? You don't fit those categories. You're off the chart. The good news is we'll still approve you, but it's going to be expensive. And so a lot of families realize, hey, I'd rather be able to get something and have it be expensive than have nothing. And so what I would recommend to everybody, we've had a lot of people come through these workshops and they say, hey, my family member who's got some health issues, type 1 diabetic, for example, they were declined over at company XYZ. I'm here to tell you there's solutions for those things nowadays, even if it's a table rating. So when we look at it, there's something to be aware of, however, called the timeline of insurability. There will become a point in your life, whether it's because of your age, meaning 85 years old, or because your health, where you will no longer qualify to be able to buy life insurance. And I'm here to tell you, of 20 years of being in the insurance business, in the financial business, most people think about it when it's kind of something's going on, and that's not the time to do it. So the one thing to know about rate classes, you guys, is once you're in a rate class, you're locked in that class forever. They cannot change it unless you get out of the policy, okay? Or again, are you still insurable? Do you still qualify? So we don't know. Everybody's got their own situation here. Okay, let's go on here. And we're going to go to page 31, and we're going to do a little drawing. If not, you can maybe have this in a notebook. We're going to just do a little drawing and talk about the different types of life insurance. Starting with the most basic, probably the most common type, which is called term insurance. By the way, you guys, the word term means time. So term life insurance is pure life insurance. There's no cash value. There's no cash accumulation. In most situations, you're not getting your money back. There are some exceptions to that. But in most situations, term is temporary life insurance. You buy it for a preset amount of time and it has an expiration date. That's awesome because it's very affordable. So again, it's like renting an apartment or renting a home. There's nothing wrong with that. As a matter of fact, there's nothing wrong with that at all. Sometimes it's perfect for people. So again, depending on the situation, term is a great product. We like term insurance. There are many types of term, however. There's what's called annual renewable term. What do you think? Well, every year it goes up a little bit. Or you could do what's called level term. You could buy it for a period of 5 years, 10 years, 20 years, 30 years, even beyond 30 years nowadays. They're actually going into 40-year term insurance policies, which is awesome for people because it's a long time. There's also what's called group term. Most people are familiar with group term. Why is that? They buy it through their job. It's cheap, it's provided, it's often free or a couple of pennies on your payroll. It's not a lot of money. It's better than nothing for sure, and everybody qualifies for that stuff. On the other end of the spectrum, there's what's called permanent insurance. This is what's called term insurance with cash value. People say, well, no, Rob, that's not term insurance, that's permanent insurance. No, I'm telling you, from the insurance company's perspective, it's all the same. If they have $500,000 over here or $500,000 over there, if someone dies, they have to pay $500,000. So for the company, it's the same. One of them builds up what's called equity, a cash value. There's a lot of people in the world who don't like the idea of cash value insurance. And I'm not here to debate that, you guys. Again, this is an educational class. You can form your own opinion based on that stuff. There are many types of permanent life insurance, okay? Here is a few of them. What's called whole life, probably the oldest one. That's like an iPhone 1. It's a really outdated iPhone. You shouldn't buy those old iPhones, in my opinion, okay? Then there's what's called universal life, variable universal life, and index universal life. We're going to get into some of the terminology. Again, not to bore you with details, but just to give you an idea. These are also referred to as cash value policies, like we said. Okay? Hopefully I'm not going too fast for anybody. All right. We're going to do some drawing here. And here's term. We're going to just pull this up. So the first little area on page 31 in the middle where it says draw 4 pictures, annual renewable term, I want you to draw that. Just a straight line. The premium goes up every year. Just a little bit more, a little bit more. Super cheap though. You can buy it. It's so cheap to start with. Every year it goes up a little, goes up a little, goes up a little. Over time, it goes up a lot. People have got to be aware of that because usually when it goes up to a certain point, people start saying, you know what? I don't like this. It keeps going up every 12 months. During a pandemic, it goes up. So a lot of people are kind of against those sort of policies, although they're out there. Then there's what's called 5-year term. Again, like a little staircase, and it represents little series of 5-year segments. The premium only goes up every 5 years. It starts a little higher than the annual renewable, but it stays the same for 5 years. But let me ask you, if you look at those pictures, what is the direction of the line? One is a sharp up, smooth uptick. The other is a sharp staircase uptick. But over at the end of the day, they both go up. So it's the same. It just depends on how people like to pay for it. If we pull up 10 and 20 year, it's the same sort of drawing, except it is a longer period of time that your premium is set. The most popular one in the United States when people set up term insurance is 20-year term. It's awesome. It's affordable. Most people can afford it. I will tell you, for certain age groups, it is less expensive than iPhone insurance. I mean, it's unbelievable. January of this year, all life insurance companies in the United States were mandated to update their cost tables. And so a lot of people don't know this. The pricing on everything has changed. And so it's just easy to understand. Term insurance, set amount of time, okay? We're gonna look at how to read an illustration together. If you ever have bought life insurance, or if anybody tries to maybe sell you life insurance, they're typically gonna show you something like this. And I know it's in the book, I know it's a lot of numbers. I'm gonna do my best to go through this. We're even gonna skip 1 or 2 pages just to make us effective here. And so this is a typical term insurance policy, a 20-year term for a 30-year-old client who is a preferred plus non-smoker. Really healthy guy. Preferred plus is really good. You'll notice his premium is how much money right there? It's $258 a year. Yearly premium, about $20 a month for that policy. 20 years later, his annual premium goes to $4,325. So ask yourself, if you're on the call, if you have an insurance plan that you pay $20 a month for 20 years, and in the 21st year, your monthly amount goes to about $350, $400 a month, what would you do? Would you keep it or would you cancel it? Because I'm here to tell you statistical information. According to LIMRA, 99% of term insurance never pays, because when the cost goes up, it's so sharp, people say cancel it, or they say I can't afford it. So it's important to understand. If we look at another illustration, for the same 30-year-old who's now a standard non-tobacco, only thing we changed was that rating from preferred plus to standard. So you'll notice his cost went up to now almost $500 a year. So it went from $20 a month to $40 a month. So it's a sharp increase. Again, illustrating in year 21, this major increase again. There's a couple of pages of these illustrations, you guys. For the sake of time and effectiveness, I don't think this is the most important part of the workshop. And so I am going to go on, and I'm going to tell you one thing I would like you to do in your workbook. On page 38, if you do have a workbook or if you're taking notes, just put a little line through page 38, because we are going to skip it because we find it leaves people a little more confused than we like. And so we have a brand new revision on these workshops. We're waiting on any day. So I'm going to just skip through this page, and we are going to continue on page 39 here in one moment. Okay, so some advantages of term insurance, because there are a lot of them, okay? Primarily, here it is, low cost. Cost is important. Affordability is important. If you're young, man, it's affordable. It's almost surprisingly affordable. It's affordable. I don't want to beat a dead horse, okay? And it's a good bet if you want it for 20 years or less. Or if you have young children and you say, hey, I want to protect them for this 20-year period of time. Or you just bought a house. You got 30 years of a mortgage potentially. You maybe want to protect that. Again, or like the screen says, maybe you can't afford a cash value policy. Again, there's nothing wrong with not being able to afford to buy a house. If you're renting, it's okay. It's up to you. So again, there's advantages and disadvantages. So again, if you can't afford a permanent one, term is definitely the way to go for 90% of people. Some disadvantages to point out, just to be aware of, however, there's no guarantee that they will renew. Some people say, no, Rob, they guarantee mine. Yeah, I understand, but read the questions that they're going to ask you. If your health has changed, those guarantees go out the window. So we have so many clients that they say, hey, my father was diagnosed with this illness. He's going to renew his life insurance, and they're giving him a hard time. And I say, of course, he's ill. So it's important to understand that when there's not a guarantee that they're going to do that for you. And I have a personal experience in my own family that, again, if we have more time, I would go into, but it impacted my family in a negative way when my stepdad or stepfather went through this. You also run the risk of becoming uninsurable in the cycle. So imagine, some people say, well, here's my plan. I don't have a lot of money, so I want to buy 10-year insurance. And I say, that's awesome. But what if in the 10 years they get a diagnosis of high blood pressure, high cholesterol, heart disease, liver disease, cancer, bone disease? We have so many people that we've personally interacted with over the past couple of years. It's an eye-opener of people getting sick. And so it's like, again, we don't know what the future holds. And so again, we don't want people to become uninsurable. If you miss paying a premium, your coverage will typically lapse on term insurance. And so, again, it's very important. There's no flexibility on term insurance. If you don't pay, they cancel the policy after a little grace period. Your policy will lapse. And so that can be a bad thing for people, okay? Some continues here. The future rates are extremely high. I think we've already said that. And again, if your policy lapses, it's like car insurance. You pay it, you don't benefit. Where does that money go? And we feel that the families should be benefiting and not the insurance companies. Again, I do not represent an insurance company, and so we want to keep that money in the pocket of the people. Page 39, let's do some true false. The insurance company will guarantee the renewal at the end of the term. Well, we just said that. That is false. Term insurance has a low net cost. We just said that is very true. Term insurance is a good option if you want it for 20 years or less. Yeah, that's true for sure. And term insurance has flexible premiums, which means you can skip payments without it lapsing. That is not true. That's a false one. Okay. And future term insurance renewal rates are lower. Again, that is false. Okay. Awesome. Real simple. We move on to the subject of what's called group term insurance. Very easy to understand. The benefit is typically 1 to 3 times your salary. Again, is that enough? Hey, you got to ask yourself. By the way, I ask you to maybe role play before I lose this thought, especially if you're married and you have a spouse. I challenge you sometimes to go home and with a blank sheet of paper, without your spouse's help, maybe you go into separate rooms with that blank sheet of paper, and at the top of it, you write down, what's my situation? And I want you to pretend in your mind the agony and the sorrow of losing a loved one, and find out really quick, how much do you know about the situation you're presently in? Do you know about the insurance? Do you know the policy number, the company, the phone number? A lot of times people don't know anything about this because it's not often discussed. So group term, 1 to 3 times may not be enough. You don't need to qualify, so that's a great thing if your employer offers that. It's very inexpensive, like we said. Unfortunately, it's typically going to terminate when you leave your job. So many people say, Rob, I don't need insurance because I have it through my job. And I say, I understand that. When you leave your job, which you will leave your job at one point, that life insurance will end. And at that point, you would possibly have to requalify. So it may not make a lot of sense to only own group insurance. There's another product that many people own called accidental death and dismemberment, what is referred to as AD&D. This is inexpensive, but not a good value. We find usually those policies are not going to pay. I have personal stories of clients thinking they're going to get money from these policies and unfortunately not getting anything because the husband would die of a heart attack or something that was not an accident. So again, you got to think about your situation. Again, this is about education. I don't know the situation. Should you buy life insurance with the rest of your life in mind? That's up to you. That is totally up to you. Some people say, no, I'm not worried about it. That's great. You don't have to. How long will you live? Some people, they buy a 10-year plan. Well, what if you buy a 10-year plan, but you live 11 years? You know, that's hard for your family to deal with. Will you want it or need it in your senior years, your retirement years? Is it important at that point? Some people, they're not sure. They haven't really been able to calculate that. Will you need it to potentially pay estate taxes? If you have an estate in this country, the estate tax rate is about 50%. So it's important to understand this stuff, okay? So let's continue on page 40 and get to the first area of what's called cash value insurance, the oldest version called whole life. Many people say, yeah, you're in the hole for life. It's not good. I'm not saying it's good or bad. I'm just here to tell you kind of how it works, okay? You'll notice the cost of insurance goes up just like the term. However, that line, that is a steady line across the middle, the green line right above where it says cash value, let's say that line signifies your premium. It never goes up. People say, see, Rob, my policy doesn't go up. And the answer is no. You'll notice at day one, you're paying at this level, but the cost is at this level. So the policy is building up what's called a cash value. And inside of whole life, it's earning a little bit of interest. And as you get older and that cost is now greater than what you're putting in, let's say you're putting in $100, what if the cost every month is $200? The difference of the money, they take it from your cash value. It pays for itself. That's kind of the concept of what's called whole life. So we pull this up, you have a fixed premium for life. People say, well, that sounds good. Well, hang on. The cash, if you want to use that money, is available only by loan. You are not able to withdraw from whole life policies. It is only available through a policy loan. It's just the way the laws are written. It is a very low guaranteed rate of interest that you're going to earn on that money. And it sometimes pays what's called a dividend, which can be used to either lower the premium. This part's not that important, so you don't feel pressure to write this. Buy additional insurance or add to the cash value. Here's what I'm here to tell you just to simplify this. Dividends in the investment world are usually a good thing. Dividends in the insurance world are a bad thing. Dividends in the insurance world is like a tax rebate. It is a return of an overcharge of the customer. So people say, no, Rob, my company pays dividends. I go, come on, that's not a good thing. So you've got to understand the difference in the two. So we just feel that that may not be the best thing for people, although whole life is a great program for a lot of individuals, okay? It is also the least flexible of all permanent life insurance. the least flexible, okay? So what I want to do is at the bottom of page 40 in your workbook, I'm going to give you a little homework. It's very, very simple, and it's not that important. I want you to put a little star at the bottom of page 40 if you could, and what I would like you to do is try to use the table on the next page to fill in those lines, okay? It's not that important if you don't do it. That's why I'm going to let you do it as homework, but we want to go on, but I want you to maybe look at those numbers for the illustration purposes. So we want to go to the next page here, talking about the next idea of permanent insurance. So you have whole life insurance. And then as those policies evolved, people said, okay, we don't like the rigid structure of whole life. We want some flexibility. And so they came up with what's called universal life. And the word universal, you guys, signifies the word flexible. If you have a universal life policy, you have a flexible premium. You can pay more, you can pay less, you can skip payments, you can take a break if you need to. People say, wow, that's pretty interesting. But again, just like term, just like whole life, the cost goes up. We overpay in the beginning. They use that money later to pay for the policy as those costs go up. It's interesting to look at though, because I want to dive into this before we get to the specifics of some of these. On page 42 at the top, it says there's 4 things that are going to happen in life. Think about it. Number 1, there's a financial emergency. Some of us are going through an emergency right now. We feel having flexibility is a good thing. You need flexibility. Number 2, maybe a financial opportunity. Hey, Rob, I got a chance to go do something. I would like to skip my insurance premium for the next 60 days. No problem. If a policy, some people, they like the flexibility of that. Number 3, you stop working. Hey, can I not pay my policy? Some of those policies give the flexibility. And then again, maybe dealing with a death, maybe losing a spouse. People say, okay, I lost my spouse. I would love to skip the payment on my policy. So we like the idea of flexibility, especially in the world nowadays with the economy the way it is. So let's think about this though for a little bit further. Let's say you had $100, $200, $300, whatever it is. Let's just say $100, and you wanted to save $100. You wanted to invest a couple $100. Forget life insurance for a second. Where's the first place that people go when they want to save money? The first place that they maybe put a stimulus check if they get it. The answer is, you probably said it. The first place most people go is to the bank. They go to the bank. Why do they go to the bank? Well, a few reasons. It's safe. It's liquid, which means you can get it if you need it. You have a guaranteed rate of interest. However, it's a very low rate of interest. And so that's kind of the only negative there is the low rate of interest. So a lot of people, they say, yeah, I don't like the bank. I don't make any money. So what I'm going to do is I'm going to go talk to my brother-in-law, who's a truck driver. No offense to truck drivers, by the way. And I'm going to go get investment advice from my truck driver brother-in-law. I guess the reason I say that is so many people don't know where they get this information from, and they often get confused. They jump from the bank, they go right into the investment world, the stock market world. They say, hey, what stock can I buy? What do I do to make money? And the reason that people are doing that is there's an opportunity for more growth. There's an opportunity to outpace inflation, for your money to grow faster than the cost of living. That's important. There's an opportunity for ownership. People like that. Here's the downside is risk. So which is better, the bank or investments? People say, well, I like one, but I don't like, so it's confusing for a lot of us. Here's the dynamic. What if we took that money and we put it into an insurance policy, and we looked at how the policies could perform from a building cash accumulation standpoint? This is helpful for a lot of people because there's a lot of ideas behind this. If you look at a lot of wealthy people who are looking to put away a lot of money for retirement. Here's an example. On page 43, if they had a, let's say, a $500,000 policy, there's this value building up. There's a cost coming out of that policy for that life insurance. Well, if we look at a regular universal life plan that's out there, your average return on the cash is about 3% interest, somewhere in the ballpark. So if maybe you're on the call, maybe you own one of those plans, go look at it after this tonight. Look at what you're earning, because some people say, I wonder what I'm getting. Some people may be earning better than that, but around average, around 3% on a universal life. Other end of the spectrum, there's what's called variable universal life. You'll notice there's a question mark on the screen. Variable universal life is an investment in the stock market using an insurance plan. So the answer is you can make money, you can lose money. Some people don't like that being tied with their investment, so variable is not as popular as it once was. However, in the middle, there's what's called index. If you look up a guy named Warren Buffett, if you look up a guy named Tony Robbins, you look up a lot of people, they always say invest in the indexes, invest in the indexes, buy an index fund, buy an index. You can buy what's called indexed universal life insurance, where here's an example. They will give you two ranges of interest, one being a floor, one being a ceiling. And they would say, and again, the screen shows an example, a 15% ceiling and a 0.75% floor, which means if the stock market index is up 10%, you get 10%. If the index is up 20%, you only get 15 because of that cap. However, when the market is negative because of the floor, you would gain 0.75. And so it's an interesting concept, and we're going to look a little bit further as we go. But let's just talk the big picture, the benefits of universal life plans in general on page 44. Okay, some benefits. You can increase or decrease the insurance amount at any time. Whole life, you can't do that. Term, you can't do that. So again, people like flexibility. Any plan that has the word universal in it has these features, okay? It's just the way they're built. You can design a policy so it pays just the face amount, which is what's called the death benefit, and the cash value built up, or just the death benefit. I don't want to get super technical, but there are ways to build policies. Not a lot of people understand them, and a lot of people misinterpret how they work. And so again, there's two ways to do that. Actually, there's a third way to do it. You can also vary premiums, skip premiums, and stop paying premiums. I'll tell you a personal true story. I went through a crisis in my life many years ago, 2007. Was one of the biggest challenges I've ever went through. I called the company because I had a universal life policy that I actually still own to this day. And I asked them, I'm going through a situation. Can I skip my payment? And the gentleman said, yeah, let me take a look. And he said, yeah, based on where you're at, you could skip your payment for the next 7 years and your policy would be fine. And I'll tell you, I didn't skip it for 7 years, but I was very relieved to realize in a crisis, I had that flexibility. So again, a lot of people like that feature. You can also add multiple people to one policy, and a big one, you can add a long-term care benefit. Maybe one of the most talking about things in this country. We're going to educate you a little bit on long-term care as we go. It's important to understand. There's also something important to understand of what's called a surrender charge. All permanent life insurance policies from all companies have what's called a surrender charge. It's normal, but you've got to be careful. You don't want to put your money into something that you think you can get it out earlier than you can. And so just be aware of that. You got to ask, again, tonight is about learning how to ask better questions on this stuff and really getting a better idea. Okay, so as we go on here, the bottom of page 44, there's a little breakdown. It's interesting that universal life and whole life policies break down the cost structures differently. And really the message that this tries to get across is whole life policies are not required per the law to disclose some of this stuff. And so some people look at the left side, they go, man, what are all these charges? The point is, it's not really transparent. So we feel like people should get a better breakdown of how that works, okay? So in your workbook, if you're filling this in on page 44, I am gonna help you. At the bottom of the page, it says what is not considered a policy cost. There is no postage, there is no printing cost, and there is no management fee. You can eliminate those in the workbook. And it says whole life policies are required. That is a false statement. They are not required to disclose those things. Page 45. Let's shift the thinking a little bit. Let's talk about taxes. There's some tax advantages to life insurance. Not a lot of us are aware of, okay? Number one, there's a tax-free death benefit. If you're my brother, my sister, my business partner, whoever, and you're my beneficiary and I buy $1 million of life insurance, I pass away, you receive that death benefit, income tax-free. You don't have to report it. It's tax-free money. So it's a big thing for people to be aware of. Some people say, no, you have to pay inheritance tax. No, you may be misunderstood. It's income tax-free death benefit. We also have tax-deferred earnings. So in the policies that have value, that value that's earning interest, those gains are not paying tax today. They're not paying tax tomorrow. They're paying it way in the future. So that's a good thing. So the money can actually compound and grow. You also get tax-free withdrawals and tax-free loans. Quick story, I had a gentleman call me about 90 days or so ago now. He's had a policy for 19 years. He's put a couple $100 a month in this policy. 44 years old, just took out $100,000. No tax, no penalty, doesn't have to repay it. 44 years old to put down on a new house. And so a lot of tax benefits to the values of those policies. It talks about formula 1020. We're going to actually talk about this several times throughout the workshop. And it's a simple rule to calculate what you need. And it says, number one, if you die too soon, you need 10 times your income to protect your family. Again, we did a dime method. We also said income times 10. It's up to you. Income times 10 is a general rule of thumb, okay? Dime is more specific. But also, what if you live too long? This is the scary thing for a lot of us. A lot of us are maybe not worried about dying too soon. Maybe we've got that taken care of. What if you live too long? You need a lot of money. They say you need 20 times your income to have enough to retire off of. So it's a lot. So if you make $50,000 a year, I don't want to depress you, but it says you need about $500,000 of life insurance, and you should have about $1 million in cash savings to have enough to retire. It's a lot of money. 20 times your income. Again, don't be discouraged by that. Some people say, oh, I'm never going to do it. It's okay. Some progress is better than no progress, because you should know essentially what you need. You need to know what's called your FIN number, F-I-N, financial independence number. What is it? You got to know. You got to have a plan. Hope is not a good strategy, okay? So page 46, let's talk about winning the money game, building strong financial foundation, just some cornerstone ideas that we feel like people need to think about. You should ask these questions when making your financial decisions. Number one, can it potentially grow to achieve my goal? Meaning, if I deposit my money into the bank account, does it earn any interest? The answer is it does not. So I can't be disappointed when it doesn't grow. So can it grow, number one? Number two, is it safe enough? What's more important for you, growth or safety? Some people right now, they go, oh, I'm a little nervous. So again, you've got to ask yourself that. Is it safe enough for your situation? Number three, does it have any tax advantages? Are you pumping money into your 401k? You got to learn about what's going on with taxes. If you are, I'm not saying it's good. I'm not saying it's bad. I'm just here to tell you, you've got to learn what's going on with taxes right now. If I could give you any message, and I'm not a tax advisor, does it have tax advantages? Because most people, they're behind on retirement. And when they go to retire, they're going to get a big tax bill, much larger than they're anticipating. So they're already behind, and they're going to have less because of taxes. And so we've got to have a tax strategy in place. And number four, does it have proper protection? If I get sick, what happens? If I die too soon, what happens? So ultimately, you've got to be able to build a strong financial foundation and ask yourself, out of those four, which one would you want to do without? It's hard to choose. It's like, I kind of want all of those. So again, just some questions to ask yourself as we go. So again, looking at these, all those policies, the cost goes up. The basic breakdown looks like this, just to kind of help you remember. Term is pure insurance. At the top of the screen, WL, that's whole life. The cash value earns a fixed rate of interest. On the right side, the universal life, the cost goes up. Cash value is a flexible interest. It's going to vary depending on the company, depending on what they give you, typically higher than whole life with a flexible premium. The bottom, what's called index universal life, again, you have the index and the flexibility. We're going to go through an example. I love the example here. The idea of a cap and a floor. Some people say, no, I don't like that. You know, you limit it. If I'm at 15 and it's up 20, I don't get all of that. Let's do an example. And it's in the book that we're going to do it together. And there's actually one typo that I want you to fix. It says in the workbook, a 13% cap and a 1% floor. If you could change it to a 0% floor. Again, all companies have different sort of products. So we're just going to kind of change the numbers here. We have an indexed policy with a 13% cap and a 0% floor. And we're going to compare that against an investment in the stock market without the cap and the floor is what we're going to do here. So here's an example. You have $100 to invest, and that's it. And you say, you know what, Rob, I don't like that. That doesn't make any sense. I'm going to go put my money directly in the stock market. And you put your $100 in, and year number one, you get an 18% rate of interest. How would you feel? You would say, man, that's pretty good. One year, 18%, it's pretty good. The reality is what goes up usually doesn't stay up, not forever. There'll be some correction. Let's say the second year you go negative 15. Here's the question to ask yourself. If you make 18% interest and then you lose 15% interest, where are you? The answer is you're back to earth, back to zero. Some people say, no, I'm still up 3. No, you don't understand interest. We can teach you this, by the way, okay? You lose 15, you go back to $100.30. Year number 3, if the investment goes up 10%, you would be at $110.33. And year number 4, if that same investment went down 5%, I know it's cut off on the screen, but you'll see it on the far left, you're at 104.81. So if we end the exercise, and I say, okay, well, the guy in the market, he invested money, and 4 years later, he made $4.81. It doesn't excite me. He made about 1.2% interest a year. That doesn't make any sense. What if I had the exact same conditions, same stock market, same economy, same president, same everything, but we said, here, put a cap, put a floor. Let's protect those gains. In year number 1, if it went up 18 and you had a 13% cap, you would hit that cap. You would only get 13%. I'm so sorry, your friend would win. You'd be at 113. But the next year, when the market drops 15, you would stay the same. People say 0 is your hero. Right now, stock market, it's kind of up, it's kind of down, it's moving around. A lot of people are nervous. It was down as much as 31, 32%, so that can hurt people. 0 might be your hero. The market then goes up 10% from there. You'd be at 124.30, and then the market drops 5. You stay the same. So here's the dynamic. 2 people, same moment in history in the stock market, same economic conditions. One has a cap, one has a floor, one doesn't. And the end result is pretty clear of where that goes, having growth and safety. So it's an important concept for people to really realize. It's out there. Not a lot of people are aware about it, and it's out there, okay? So there is a little check box in your workbook on page 42. I'm going to pull this up on the screen literally for like 30 seconds, 45 seconds, just so we don't have to take too much of a pause break because we're almost at the end of our workshop. But what this is, it's a cheat sheet in a way for you to compare basic features of term insurance, whole life insurance, all these different things, again, because they're out there. And so, again, I don't want you to become an insurance guru. I just want you to know, hey, what's my situation? What's the right thing for my situation? Is it renting? Is it owning? Do I need cash value? Do I need term? I don't know. But at the end of the day, most people, they don't know how to make that decision because they have no education. Because an agent, an insurance professional is normally, hey, here's the policy, here's the policy. So again, maybe this is valuable. Hopefully you're taking something from this. And so again, hopefully you can check all those off. If not, I can come back at the end, but we're gonna move on. One thing we like to talk about here, and I know it's in your workbook if you have it, is the power of choice. I don't know if it's gonna be on the screen or not, but again, our company we're not an insurance company. We're not an insurance organization. I just really want to clarify that because some people get on a class like this and they go, oh, they're probably trying to sell some life insurance. No, we're not an insurance organization. We believe in the power of choice. We've partnered with every life insurance organization literally in North America. I don't want to say every one, but nearly every one. And so we have access to all that information to help people. And so there's another little caveat, little niche area out there called final expense insurance that a lot of us are aware of, but a lot of us are not. And it's typically for small amounts of coverage, usually to pay final expenses, burials, cremations, things like that. I don't know if you've ever lost a loved one and had to deal with that. I don't want to deal with it. And it's something that all of us are going to deal with. And so I feel like people may not need life insurance. That is a true statement. They may not need it depending on their situation, but they probably should have some final expense because that's a sure thing. And I don't want to have to pay for that, especially at a crazy time like this if something were to happen to somebody. Usually for people with health issues. So something to keep in mind, somebody may not qualify for regular life insurance. They usually can qualify for final expense. Again, smaller policies. So it's helpful for a lot of families out there. Easy to apply, typically no medical testing. Nowadays, over the age of 50, not even a telephone interview. We basically just do an application and they approve people if you just answer some questions. So it's very easy for people. And a big point is what's called a concierge service. Have you ever planned a funeral? Have you never planned a funeral? There's two different scopes here. If you have, are you looking forward to doing it again? People say, heck no. And if you never have, are you looking forward to doing it? People say, heck no. So we really recommend something what's called a concierge service, where there's licensed funeral directors who work on your behalf, to where the family, your kid, your spouse, whoever it might be, they don't need to deal with the burden of negotiating prices and dealing with, burial places and funeral places, because it can be very difficult for people, the emotional burden. So we want to put that on maybe a concierge. We like that concept. It's good peace of mind for people. Again, we talked about the power of choice. Again, this is on the screen. These are all household names: Transamerica, Nationwide, Pacific Life. Again, there's a lot of great companies out there. There's last time I looked, about 600 life insurance companies in the United States right now. So there's a lot. So let's do some summary before we get to the very end, you guys. Just on page 50 as we get to the end. We're gonna tie this together. Term insurance, again, no cash value, low cost. You can renew it. The cost is gonna go up. There's no value. There's no equity. There's no ownership. It is temporary. Understand, if you buy it, it will expire. If you're okay with that, that's perfect. That's probably the right thing for you, okay? Especially if you need it for a short period of time. There's a concept out there called buy term insurance and invest the difference. Rather than buy a permanent insurance policy where you have to put more money in, buy term insurance and take that difference and invest it. It's a valid concept if you invest it, if you have the discipline, if you know where to invest it. So again, there's a lot of ifs in a lot of scenarios out there. We didn't talk much about it, but variable policies, variable universal life, as we kind of summarize, for people who like the idea of stock market risk. They want permanent insurance for life, again, but it's a risky sort of plan with a lot of potential for growth. I know the past couple of years, VUL life insurance plans, some of them are up 20, 30% interest inside of the policy, no taxes due on that money if they do it right. So it's powerful if you do it the right way. We talked briefly about indexed universal life. Again, people have to put more money up front, buying a house, flexibility of premium, nothing to renew. Again, building equity. I feel like a broken record. I feel like I've said all of this, but I want to end strong. And so insurance for life. And again, it's typically, if you were to compare it to a cell phone, it's the iPhone 11. It's the Android, whatever the new thing is. Again, I don't want to say new. Indexed universal life has been in the United States since the early 2000s. I know I first started getting some training and exposure in about 2005. And so we feel like we're pretty educated on all of this stuff. It's a good plan for the long run for people. So let's answer some questions and we'll get out of here, okay? I know we're right on time. It says, if I have a little bit of money, but I want to protect my spouse and my 3 kids, I should buy term insurance. Typically, that's probably the answer for that scenario. If you want long-term growth with your life insurance and you understand the risk of the stock market, you may want to look at what's called variable universal life. If you want a life policy with long-term growth, but you don't want any risk, you probably want what's called indexed universal life, a better alternative to VUL. And if my parents may have some health issues, but I want them to have some amount of coverage, you could buy them, again, final expense insurance, okay? So we are at the homework, you guys. Congratulations for successfully surviving a life insurance workshop. I know it's not easy. I am proud of you. It's not easy for me as well. Again, I was telling the guys earlier, this is only the second time I've ever had to do this. And so hopefully this form of learning is effective for you and you're taking some value. I hope I didn't go too fast, but here's the homework. Again, everything's optional. This is a volunteer army, okay? So no forceful homework here. We recommend, I don't think there's many things to fill out in here, maybe 1 or 2 little areas to fill out. We do recommend sit down with the person that maybe invited you to the workshop or ask questions. Help us, help you in the situation of really figuring that out, because again, some people feel intimidated or embarrassed. Again, if you need it, we're here to help. If not, that's all good. Maybe you learned enough to do it on your own. That's totally good with us as well. If you have the blue Saving Your Future book, the physical book looks something like this. If not, you have a PDF. If not, again, please get with us. We can get you a hard copy of this or email it out. Presently, we have this available in English, Spanish, Vietnamese, and Mandarin Chinese. We should have 2 more languages very, very soon. And so if you know of people that could benefit, please let us know. But I would ask you to read pages 23 to 48. I know that's asking a lot. I know some of us are on lockdown, some of us are not. Look, if you read those pages, it may help you tie this together. Again, this whole program is like a gym membership. You're going to get out of it what you put in. And so if you took enough from tonight and you say, hey, I got it, that's awesome, I'm on to workshop 3, that's okay. But if not, we would really recommend you read and maybe just solidify some of this info. Again, if you could think of anybody that could benefit, again, share it with them. We're going to continue this next Thursday with workshop number 3. An awesome subject, you guys. Let me end my my screen sharing here so I can see everybody. Next week is about building wealth and accumulating assets. Something that in the richest country in the world, people have done not a very good job of. You know, and I just, as maybe a little, to preface it, I want you to think like this. In the past 3 years, 4 years, 5 years, can you write down in your workbook 5 things that you've purchased with your hard-earned money that have went up in value? Most people struggle to complete this exercise because most people spend all of their money on things that go down in value. And you can think about some of those things. And so we're going to get into that next week on a really awesome subject with valuable things that I know will be beneficial for you. And so, again, hopefully you took something from tonight. While we're here, does anybody have any questions? I guess since there's only 21 of us on here, you know, if we want to take a moment and unmute, if anybody has any questions or comments, we can take those. If not, we can say amen and end the meeting. I'm good with it either way. I'll give you guys a few seconds if anybody does to chime in. If not, we're going to wrap up. So it looks like we're good. Hey, listen, if you have a question, we are here to help. We are on a campaign to educate 1 million families by the end of this year. We are on track to do it and exceed it. I'll see you, Victoria. We appreciate the message. I appreciate all of you taking the time. I know it's a big commitment. Hopefully, again, you guys learned something. We'll see you next Thursday. Follow up with who invited you. We'll get you the registration link for that workshop and help us spread the message, you guys. Again, let's help the community. It's a time of craziness in the world. So I think we can, a group of 21 people, I think we can make an impact in our little circles of influence. So anyway, you guys, peace and love, rock and roll. Have an awesome night. I'm going to finish my coffee. I'm going to go home and see my dog and see my fiance and have some dinner. So have a great night, you guys. We'll see you all very soon. Okay. See ya. Bye.